Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the ever-evolving discussion of the Fed's independence, my interview with Longbridge Financial's Chris Mayer on HELOCs for seniors and how the mortgage industry can better serve aging homeowners, and further reaction to Friday's payrolls report and the fallout from it. Thanks to today's podcast sponsor, Total Expert, the purpose-built customer engagement platform trusted by hundreds of modern financial institutions. Total Expert turns customer data into actionable insights that help lenders engage and guide consumers through complex financial decisions. By fusing digital touchpoints and human interactions, Total Expert humanizes the customer journey to create better financial outcomes, build deeper relationships, and win customers for life. Visit TotalExpert.com to learn more. How can we be in the waning days of summer already? Didn't the school year just end? Here in Central Michigan at the Michigan Mortgage Lenders Conference and next week at the California MBA's Western Secondary, come say hi to me if you're at either of those. An important topic is our Federal Reserve being in the crosshairs of the current president. One Federal Reserve District president resigned on Friday, rumored to be because of pressure. Under pressure. Is Jerome Powell right to ignore the clamoring? The irony is that in refusing to be the central banker everyone wants, Powell may be fulfilling the role that the economy actually needs. There is good news, however, on the abusive trigger lead front. In the Homeowners Privacy Protection Act, H.R. 2808, it's set to go before Trump, but it may not be the cure-all originators are hoping for. There are criteria, so your legal team should read it before you stop advising clients to enroll in the Do Not Call list. Yes, 6 months after the enactment of the bill, when President Trump signs the legislation into law, trigger leads will be permissible under the Fair Credit Reporting Act only in limited circumstances during a real estate transaction and only to prove a firm offer of credit. A credit reporting agency, or CRA, would not be able to furnish a trigger lead to a third party unless the third party has certified to the CRA either the consumer explicitly consents to such solicitations, the third party has originated the current residential mortgage loan of the consumer, the third party is the servicer of the current residential mortgage loan of the consumer, or the third party is an insured depository institution or insured credit union and holds a current account for the customer. That's actually kind of nice. Like, gives your old mortgage company a chance to say your credit was pulled and set them up. And before we get to our interview, let's turn to last week quickly. Midweek, the Federal Reserve held rates steady, with Chair Powell signaling no immediate plans for rate cuts, causing a sharp market sell-off and a plunge in expectations for a September cut. That sentiment was validated after hotter-than-expected inflation data, with core PCE rising 2.8% year-over-year, highlighting the Fed's struggle to reach its 2% inflation target. However, July's jobs report came in well below expectations, with just 73,000 new jobs and downward revisions erasing 250,000 jobs from prior months. The continued back-month downward revisions would seem proper justification for the BLS head losing its job, though employment figures are already a backward-looking reading. Additional red flags came from a disappointing Q2 GDP report showing weak consumer demand and a decline in residential construction. Accordingly, traders have grown more confident in the likelihood of a September rate cut, with odds rising significantly. President Trump has vowed to appoint a new Fed governor after Governor Kugler resigned last week, and labor statistician promptly. Friday's market reaction was a dramatic release of pent-up tension. For today's interview, I want to welcome to the show Longbridge Financial's Chris Mayer to talk about HELOCs for seniors and how the mortgage industry can better serve aging homeowners. He's led Longbridge's growth from a startup company in 2013 to the second largest reverse mortgage lender and the largest wholesale lender in 2023, with a 22% HMBS market share for newly originated loans. He's guided the construction of new proprietary reverse mortgage products and helped develop an innovative new securitization structure to reduce the funding cost of new loans. The last time I saw you was in a coffee shop in New York City, right by Bryant Park, probably end of May, start of June. And so it's nice to be full circle having you here on the podcast, but you're very focused in the HELOC space. You just announced a deal with Figure, which we'll get into. There's this HELOC for seniors product. Let's start with the overall landscape, and I'm going to put this in kind of layman's terms, at least from my perspective. It would seem
based on discussions I've had recently, the HELOC space is blowing up in a good way because the stigma surrounding some of the HELOC products, borrowers are learning that a lot of that fallacy. It's a great product, especially when credit card rates are 20, 30% type of thing. And there's more and more investor demand out there and liquidity in the space. Like I said, that's my kind of layman's view of it. You take us what you're seeing inside the HELOC market, both from a borrower demand, investor demand, overall landscape, product expansion, all those sorts of things.
Sure. So let me say first, Longbridge Financial is a mortgage company committed to the responsible use of home equity by older Americans in retirement to have a better retirement. When you look at the HELOC marketplace, the HELOC marketplace is, as you said, has been taking off. And I think there's a recognition that, a lot of people are, sitting, maybe the number is, 2/3 instead of 3/4, but significant numbers of people are sitting on mortgages below 4, and, the world 4 or below, and the world is not going back to 4 or below mortgages. 4% or below mortgages anytime soon. So if you want to use, and home prices have been rising until recently for much of the country. And so that meant there's a lot of home equity available. And where's that going to, how do you do it? Well, HELOC is a great solution for people to leave the first in place to pull that money out. And investors, when you sit in conference calls, listen to the different analysts, there's a lot of demand for securitized products in the market right now. That's true in the public securitization market. There's also a lot of demand, if people can figure it out, in private products and private investors. So lots of demand out there in the world. From our perspective, I'll just throw out a couple of facts of why we think the senior market in particular is such an important market. The first is 1 in 3 homes in the United States is owned by somebody who is 65 and older. And it's going up 0.3% a year because people are buying homes later, older. It's expensive with rates. But, when you get to people who are 65 to 69, 77, 78% of them are homeowners. And if you ask people what they want to do, they want to live in home, literally they want to live in their home until they're, carried out. I'm not sure I'm not sure they would phrase it that way, but, we refer to it as going over the Rainbow Bridge, in our company, but, until they head over the Rainbow Bridge, they want to be in their house. And so finding things that work for older borrowers is a big part of the market. I'll give you a couple of facts. Last year, $100 billion of applications for cash out products for people who are 62 and older. Of that 100 billion of applications, so that includes closed-end seconds, it includes HELOCs, it includes any other kind of cash out product that you see. And about 1/3 of them got rejected. So they don't have income. So it's a big market. A lot of people, about half of those people in the 65 to 69, and then it goes up as they get older, own their home outright, but they still want to pull cash out. So our company is really committed to serving that market more broadly, and it's a big market, and then there's a lot of room to grow it.
You have this product specifically for seniors, and you mentioned there was a lot that were getting rejected. I'm wondering if you could go through why people were getting rejected at such high rates, and then kind of how you remedied this.
So if you look at the people who are being rejected in that demographic, over half of them, the reason given is debt to income. So not surprisingly, if you're older, your income is going down, not up. And so a lot of people, there was just an article in the Wall Street Journal in the last couple of days that looked at, the disconnect between using data from the Employee Benefit Retirement Institute that looked at data on how people manage things when they get to retirement age. And what people say is that they're going to slowly cut down their hours and, work less and less over time. That's what 2/3 of people say. What actually happens is that happens to only 1/4 of people. Most people have something happen and all of a sudden their income goes down. And now they're left with the retirement assets, Social Security, maybe a pension, although those are diminishing. So as you're in retirement, you see your income dropping. And so the debt to income constraint, unlike a lot of younger people where LTV is an issue, for the elderly, debt to income is the biggest constraint for them. And so, we also offer reverse mortgages. And I'm a big fan of reverse mortgages, but one of the challenges is people don't think that they want a reverse mortgage, not necessarily because they understand the product or what it is. But when you ask them, many people are sort of nervous about a reverse mortgage, but they all understand what a HELOC is. They all, you can explain a closed-end second in about 2 minutes. So it's not hard to figure out, or a cash out, you're, refinancing and cashing out. But if your rates, for the vast majority of people, they're going to take a much higher rate on their loans. So cashing out isn't going to be, taking a new loan isn't going to be a great answer. So for borrowers, the rejection rate is debt to income. And that's a real problem for them. I will say, just on the reverse mortgage side, our calculations suggest 30 to 40% of that 100 billion could actually qualify for a reverse mortgage. So people who are not offering reverse mortgages are literally taking applicants that they could give a product to. And they're just literally saying, you know what, I believe in lifetime products and lifetime relationships, except if you're older. And that's fundamentally the problem, is that when you're young, if you're buying a home, everybody said, well, we need product. You can't just tell somebody you have to put 20% down to buy a home. Like, because people can't save 20% these days. So we got to have lower down payment programs. We got to have other programs to allow people to spend a higher share of income. When you're middle-aged, we're going to create special cash out programs for you. When you're older and your income's falling, we're sort of like, well, we're just going to give you the same products we had before, but that's goofy. And that's what we're really about in both our new product with Figure, that we're working on, along with kind of product development more generally. We think you ought to tailor the products for the needs of your customers.
Yeah, I do want to talk about the product with Figure here in a second, but before I get there, could you bring the audience up to speed on what conversations with potential takeouts are like, but both for what you're working on specifically, but also in general, the process of getting some of these newer products approved by investors and say, hey, this is something that we have appetite for, that we want to buy from you.
So the product we're offering, our HELOC for Seniors product, is what I would sort of call a hybrid product between a HELOC and a reverse mortgage. So the front end of the product is sort of an IO HELOC. The back end of the product is a reverse mortgage. Both those products are in market today and selling well. Our last reverse mortgage securitization, we're 2, 3, 5, as much as 9x oversubscribed in our deals. There's lots of investor demand for those. And in the HELOC market, we've seen spreads continue to narrow. And so in a way, the product is sort of, because it's a hybrid between two different things, it's really, the initial discussions we've had with investors has been, here's this product. It's a hybrid of things you already invest in different parts of your universe. And they're like, all right, well, that's, we're interested in it. You never know for sure until you're actually in market, if you're securitizing a product, how people actually look at it, or how the rating agencies are going to look at it. So there is, you're taking some risk when you go into market. But, our company is owned by Ellington Financial. They're an NYSE traded company. And Figure, is a widely accepted largest, non-bank HELOC originator with huge amounts of credibility in the space with investors. The last thing is, this product exists, just not in the US. So in the UK and Australia, this is a product that exists and is securitized. It is rated, and investors know it. So we're only kind of reinventing the wheel. We're reinventing the wheel in the US, but we're not like, it's not like there's a wheel and people before were using squares. It's sort of like it's a wheel, but you had like 8 square, 8 straight notches. It's like an octagon, and then you're turning it into a wheel, and it's not as big a transition.
Before I let you go here, I do want to ask about the partnership with Figure. Like you said, they've made incredible strides in the HELOC space.
Yeah.
And it's neat to see, because as you know, I used to work with some of those guys at SoFi. And actually, we had a guest question from Mr. Michael Tannenbaum himself. He says, Chris, why did you choose Figure to work with? And can you talk about Figure Connect a little bit in your answer there?
Sure. I mean, look, there are two things. The first is you were talking about working with the guys, SoFi, the team back in the day. I go back further with Michael. He and I actually, I taught, was a professor at Columbia for many years. I'm still emeritus there. And Michael was one of my very best students. And all the years I taught. Super smart guy, really great, and has been hugely successful at a very young age. So, and he and I have had breakfast for years, but we got together and, when he took over as CEO of Figure, they're a company that I've looked at and respected for a long time. The idea of trying to take assets on the blockchain to create liquidity and to build out Figure Connect. And if you look at the distribution they have in the, virtually all non-bank originators, and most of the largest ones are already clients of Figures. So if you ask, do we want to build a product and who do we want a partnership? Even if I didn't know Michael, Figure would be at the top of our list to do this with, but having the relationship helps, and having trust helps a lot with that. So that's how this literally happened over breakfast. He and I talked about it. He said, gee, this is an interesting idea. He went back to the office. He called me an hour later, said, we're in. And, when you're working together, there's a lot, when you've known people for a long time, there's a level of trust that can work. Now, it took us about a year to get into market. This is not an easy, simple product to create. There are all sorts of, hurdles. There's legal, there's regulatory stuff. And the partnership with them is a partnership that involves Longbridge is originating and closing the loans on Figure's technology. And we're partnering on the capital market side on the back end. And we're also partnering with talking to, to lenders to put it on their platform. So the product is available only in retail right now in one state. By the time this airs, it'll probably be in about 5 states. And we expect in September and we've had lots of conversations with people that'll start to go on platforms with Figure's wholesale clients. And it'll start as a broker product. Longbridge will originate it all. Over time, we hope to transition and use all of the kinds of resources that Figure has at their disposal, all the ways of selling the product and, working, through their distribution. And we hope and expect to get there over time, because they really are a great partner and really have had some enviable success in this space.
Mm-hmm. And I guess lastly, we started the interview talking about how appetite, both from the general public and investors, has evolved over time. And it's been neat to see the space kind of get its moment in the sun and its due. How do you see it continuing to evolve and press forward from here, both with product or program proliferation, but also the ability of companies to take bigger market share and those sorts of things?
There's $14 trillion, trillion with a T, of home equity for people who are 62 and old, and it's growing. 12,000 people a day turn age 65. So figuring out how to help people use home equity in retirement is an enormously large market that nobody has really succeeded at here. In the UK, 36% of all loans are equity release, which includes a lifetime mortgage or a HELOC for seniors like we've launched. The HELOC for seniors that we have today, just to hit the product really quickly, interest only, as long as you live in the home. And you never have to amortize the loan. So no one forces you to save money. And thus, when you qualify for the loan, you're qualifying with lower payments for the amount of money you take. And that's the secret sauce, because the lower required payments make it easier to qualify based on debt to income. And it makes it easier for people who have retirement assets or other things to amortize those and qualify for the loan. So a lot of those people who are rejected can get this loan successfully. And the people who take out the loan are not going to be forced, like a bank HELOC, 10 years in the future or 5 years in the future, all of a sudden to go from IO to a paid in full or hyper amortizing the payments. So it's a much better product for people who are older. It's a responsible product for them. Where's the growth? The growth is trying to tweak this product further to address the issue of how much people are making in payments, and to get those payments as low as possible, and to make the product origination as streamlined as possible. And in the reverse space, in the HECM space, even in the forward space, it is still a long, complicated process to get a mortgage. But the way to get a line of credit with Figure and with the new technology is much more streamlined. It is lower cost and it is really efficient. And so for us, working together to try and lower the cost of origination, to make it simpler and easier for people to originate the product, to create liquidity on the back end with investors, that's the kind of efficiency that we need to bring to this space. And $14 trillion of equity says there's a lot of room to grow here.
Yeah, $14 trillion of equity sure is a lot. You're talking 6, 7, 8 times the annual, primary origination market out there for the residential mortgage industry. So pretty cool. Chris, I really appreciate the time. Hopefully this is the first of many discussions, and I wish you and Longbridge the best of luck.
Great. Well, thanks a lot. I appreciate the time and look forward to talking again. So thanks again.
Friday's market reaction was a dramatic release of pent-up tension. The 10-year yield plunged to 4.25%, piercing key resistance levels and casting fresh doubt on lofty equity valuations. Investors of long treasuries were finally rewarded, with the odds of a September rate cut soaring from 40% to nearly 90%, with additional easing expected before year-end. Yields across the curve, that's 2s, 5s, and 10s, returned to their late June levels, effectively erasing July's volatility. While the inflation data on August 12th still looms large, markets enter the second half of 2025 with renewed optimism. Notably, the yield curve is beginning to front-run the Fed, with the 10-year yield now sitting near the lower end of the Fed funds target range, hinting at an inversion. For mortgage bankers, this signals some relief ahead as lower rates come back into play. The evolving tariff landscape is being treated more and more as a new and persistent reality rather than a temporary disruption. While most important levies have now been formalized, with notable exceptions being China and Mexico, President Trump's shifting deadline schedule is losing its market-moving power. The broader concern is no longer the specific structure of tariffs, but their lingering effects, and now central to both investor sentiment and monetary policy considerations. As investors and central banks remain cautious amid ongoing uncertainty about the broader economic toll, overall restrained posture reflects both prudence and unease. This week's calendar sees a downshift from this week's PAC's schedule, with the quarterly refunding supply, Treasury auctions $125 billion in 3 years, 10 years, and 30 years tomorrow through Thursday, likely a potential market pop. Data is limited to factory orders, trade, vehicle sales, services PMIs, productivity, unit labor costs, and wholesale inventories. Following last week's Fed events, only 3 Fed speakers are currently scheduled. Outside of the Fed, the Bank of England will be out with its latest monetary policy decision on Thursday, where it is expected to cut rates 25 basis points to 4.0%. And regarding MBS, agencies will release July prepayments late Wednesday, and Class A net out is on Friday. The week gets off to a slow start, with the Employment Trends Index and June factory orders both due out later this morning. We begin Monday with agency MBS prices roughly unchanged from Friday's close, but better considerably from Thursday. The 2-year yielding 3.68, and the 10-year yielding 4.22 after closing Friday at 4.22%, down 17 basis points for the week. Let's wrap up with a joke and some housekeeping. I don't understand why my credit score is so low. Every time collectors call, they say my payments have been outstanding. But Thanks again to Total Expert, the purpose-built customer engagement platform trusted by hundreds of modern financial institutions. Total Expert turns customer data into actionable insights to help lenders engage and guide consumers through complex financial decisions. To learn more, visit totalexpert.com.